$600 billion. Collapse. Lehman Brothers. Lehman Brothers was a 158-year-old Wall Street giant. Then in 2008, it collapsed in the largest bankruptcy in U.S. history at the time, with more than $600 billion in assets. Employees walked out carrying boxes, markets panicked, and the world realized the financial system was in much deeper trouble than most people understood. But Lehman did not fail in a single day. Its collapse was built slowly through years of risk, leverage, and overconfidence. For decades, it had been one of the most respected names on Wall Street, surviving wars, recessions, and market crashes. Its name looked permanent, and that illusion made the ending even more shocking. In the early 2000s, Lehman pushed aggressively into housing. Home prices kept rising, mortgage lending exploded, and Wall Street turned those mortgages into securities that could be packaged and sold across the financial system. The machine looked incredibly profitable because more loans meant more products meant more fees, and more fees meant more pressure to keep the cycle going. Lehman did not just help sell mortgage-related products. It held huge amounts of them itself, and that was the dangerous part. As long as housing stayed strong, the strategy looked smart and profits kept coming in. Confidence rose, Wall Street rewarded the growth, and very few people wanted to slow down while the money was flowing. The hidden weakness was leverage. Lehman borrowed heavily to make returns look bigger, which made success look more impressive during the boom. But leverage is brutal when markets turn, because when asset values fall, the debt does not disappear. It stays there and increases the pressure fast. Then the housing market started to crack. Mortgage defaults rose, the securities tied to those mortgages became harder to value, and confidence began to fade. Investors and counterparties were no longer sure what many of these assets were really worth, and in finance, that uncertainty is dangerous because once trust weakens, fear spreads quickly. Lehman's balance sheet started scaring people. Questions became rumors became panic, and the firm entered the most dangerous phase any financial institution can face. A bank does not need flames coming out of the building to fail. It can fail when confidence disappears, because if lenders pull back, trading partners lose trust, and clients start worrying, the institution can unravel with shocking speed. By 2007 and 2008, the warning signs were clear. The subprime mortgage market was deteriorating, major firms were reporting losses, and Bear Stearns had already collapsed in March 2008. That should have been a giant warning to the entire system, but Lehman was already too exposed to step back easily. It reported losses, its stock price fell, and Wall Street began asking the most dangerous question possible: how bad is it really? As pressure intensified, Lehman needed a rescue. It needed fresh capital, a buyer, or some way to restore confidence before the market turned fully against it. Talks happened, possible deals were discussed, but nothing came together in time. That was the fatal moment, because Lehman was too weak to calm the market, and no rescue arrived fast enough. In September 2008, Lehman Brothers filed for bankruptcy. The shock was immediate, because a major Wall Street institution had been allowed to fail. That changed the psychology of the crisis overnight. Now, the fear was no longer theoretical. It was real, visible, and spreading through the global financial system. Lehman was deeply connected to markets around the world. It had obligations, counterparties, and financial relationships across the system, so when it collapsed, the damage spread far beyond one firm. Credit markets tightened, counterparties panicked, trust fell across the system, and even businesses far away from Wall Street felt the impact. That is because modern finance is interconnected, and when one major node fails, the shock travels fast. This collapse was not only about numbers, it was also about human behavior. First came overconfidence, because housing had worked for years and people assumed it would keep working. Then came normalization, where risk stopped feeling dangerous because it had become familiar. Then came leverage, then denial, and finally panic, when confidence cracked and everyone moved at once. That pattern matters because it shows how many corporate and financial collapses actually happen. They do not usually begin with one dramatic moment. They begin with repeated success that creates false certainty, then bigger bets, then ignored warning signs, and finally a sudden loss of trust that brings the whole structure down. Lehman's failure also hurt real people. Employees lost jobs, investors lost money, businesses struggled to get credit, and families across the wider financial crisis paid the price. This is what makes financial collapses so destructive. The damage never stays neatly inside boardrooms and trading desks. Lehman still matters because it became a symbol of leverage without resilience, prestige without safety, and complexity without stability. It also became the moment many people realized the crisis was much bigger than one bank. A famous name did not guarantee survival, a long history did not guarantee safety, and a large balance sheet did not guarantee strength. The lessons are hard but clear. Leverage can magnify gains, but it can also destroy a company with incredible speed. Liquidity and confidence matter as much as reported assets. Complexity can hide weakness, and long periods of success can convince smart people that the danger is gone when it is actually getting worse. Lehman Brothers spent decades building a reputation that looked permanent. But permanence on Wall Street is often an illusion. When housing turned, leverage magnified the damage, trust broke, time ran out, and the world understood that the crisis was much bigger than one bank. Lehman did not just collapse. It became the moment panic went global. Subscribe for more breakdowns on corporate collapse, fraud, and financial disasters.